All right, guys. Everyone should be in the room here. I'm going to keep admitting people as they come in, and hopefully you guys can see the screen. Can someone in the chat feature give me a thumbs up or give me a yes that you can see it? Awesome. Thanks, Ryan. Thank you, everybody. All right, so we are going to jump into this because we have a lot to cover. There's a lot going on. Everyone should be muted. You guys can take off your video if you'd like. There's not necessary to have on, but I'm going to basically run through this because like I said, we have a lot to cover. Let's see here. Go ahead and add some more people in here. We got already almost 50 people in the room, so this is awesome, guys. Thank you.
That's great.
For coming in and do this, because this is kind of a last minute thing that Rick and I talked about doing late on Friday afternoon. I called him and was like, hey, I know that you guys have your finger on the pulse of this stuff because you guys have an economist on staff, and I would love to get all of our TB-RIA and just our contacts in general the ability to get a really good update of what's really going on there in the economy and what's going on there as it affects real estate. So because we had a lot of people say they were interested in this, I did open this up to 500 people. If you guys want to share this, you are more than welcome to keep sharing this because we will be going for about an hour. So this is also being recorded. So if you do have to jump out at some point, you are more than welcome to jump out because this will be put up on our YouTube channel in a couple of days. But make sure if you are not on our email list, or if you're not on Rick's email list, or if you are on one of them and you want that link, be ready for it. Okay. Let's see. Can everyone hear us okay still? Okay, good. All right. I had one person say they couldn't hear, so it's got to be on your system. All right. Real quick, guys, I wanted to let you guys know that Rick and I are doing this out of the goodness of our heart because we want you guys to be educated. Rick and I are not here to sell you some fancy schmancy guru product at the end of this thing. So just be aware that we are not here to sell you a thing. We just want you all to be as educated as possible so that you guys can be as successful as possible in your real estate investing career going forward. So there's going to be, like I said, a lot of content we're going to go over in here. But before we jump into that, I want to guys update a lot of you guys who are TB-RIA members and may have not seen our email that went out last night. We have not canceled our main meeting this Thursday night, sort of. It's not canceled. What we did is we decided to transition it into a Zoom call just like this. Our speaker, his flight got canceled from Chicago, obviously with all the craziness that is happening with all of this. We obviously want you all to be safe. We don't want anybody, shaking hands accidentally, bumping fists, getting that stuff on you. And of course, we are at a hotel where there are lots of people coming and going. Let's see here, making sure everyone's still muted. And we just want to make sure you guys are safe. We don't want anybody to get sick and whatnot. So you can still register for that on our website at tbria.com. tbria.com/events. You can go check that out. You will be able to see the main meeting is still up there. And when you register for it, you will automatically get an email link or with the link to the Zoom call for Thursday night. We are not doing any of our normal giveaways because I do not have a way to raffle anything off. I have no raffle tickets to be able to do that via Zoom. Also, some other TB-RIA updates. We are not having any in-person subgroup meetings for a minimum of 2 weeks because we just don't know what we don't know at this point when it comes to this coronavirus. We will be sending an email out letting you all know of that, to remind you of that after the main meeting in a couple of days. As of right now, April's main meeting is still on in person. Obviously, that could very much change quickly with what's going on. We will obviously keep you all up to date, and as we get more information, we'll let you guys know as well. And again, we just want to make sure you guys are all safe out there and not coming into contact with people that might be carrying it, or you might be carrying it and passing it on to someone and getting them sick, or getting someone they know love sick as well. So why don't you introduce you guys to Rick Melero. He is the president over at HIS Capital out of Orlando. They have been a referral partner of mine and TV Ria's for quite some time now. For those of you that don't know Rick, I'm gonna let him do his intro, let you guys know a little bit about who he is and what they really are doing over HIS and how they can help you guys. So Rick, take it for now.
Thank you. Can you guys hear me? Just want to make sure we're good. Awesome.
Okay, we're good.
Yeah, so my name is Rick. I'm a real estate investor, and actually over the last, I would say 15 years, we have evolved from wholesaling to ultimately starting to do our own buy, fix, and flip, and evolving that into small commercial investments, and ultimately we're lending capital to private investors. So I would say that we're pretty much a real estate investment company that has a diversified investment approach. We are in the process as we speak of finalizing our very first Reg A offering. So we're gonna have a public offering in the next little bit here where investors could come in and invest with us. It's a public offering with as little as about $5,000 basically, so that our goal is to bring a lot of our smaller investors that we couldn't work with to be able to benefit from these new changes and these new investment strategies. So in essence, that's what we are. We're a real estate investment company. We lend money. And because of that, we're stewards of different opportunities. And it's critical for us to really be aware of what's going on in the market. We have been fortunate enough over the last, I would say at this point since 2012, to have brought in on one of our team members who is actually an economist, who actually back in 2005 and 6 was predicting the correction of 2008. And so we really liked his diligence. We liked the details that he was studying, and we brought him on board. And so we've been working and collaborating with him, in fact, in a lot of detail for the last few days to put together this update we're going to share with you guys to make sure everybody's safe, but also so that everybody is aware of what is going on and what are the key things we should be doing in order to prevent a panic and prevent from losing our shirt in this market correction.
Absolutely. Yeah, so guys, I mean, I know Rick put this out to a lot of people as well that may not know me. My name is Greg Simpson. I am the president of TV RIA, Tampa Bay Real Estate Investors Association. We are the largest group in all of Tampa Bay for real estate investing. We have the most meetings all over town. We have a total of 7+ meetings every single month, or I should say events every single month. So obviously this is fairly devastating to us at this point because we're not hosting any events for the foreseeable future. We will do our best to do as much virtual stuff as we can. I think we're all going to learn how to adapt very well to this. But I primarily myself am a fix and flip investor. I've been investing in real estate for the past, just past 7 years now. And I am gonna let you guys know a little bit what we're doing. We're not doing business as usual because obviously things have changed recently, but we are still buying. I'm anxious to see what we have on the horizon because maybe I shouldn't be buying, but I'm going to find out really soon here. But we are acting as if we are still going to be making offers on every property that gets put our way. We've heard a lot of people have been backing out of deals because of the scare of all of this, and totally understandable. But, you know, if you can buy it for the right price, I still think that you have an opportunity to make a lot of money in this. So that's kind of what I'm doing. Rick, what are you guys going to do right now? And then we're going to jump into the actual presentation.
Yeah, so absolutely. So one of the things I want to do before the presentation is I'll talk a little bit about what we're doing now, but I want to save some of the key things we're doing for the very end. And what I would say is we're going to do a little bit of a format of Q&A. Yep. We're going to walk through these slides specifically to talk about some of these key indicators, some previous history. As a company, we have not ceased from doing business. We have tightened up on our protocol to make sure that we're in compliance with the government and their recommendations, because in a little bit, I'll tell you why that's so important. The other thing that we're also doing is we're following the different vendors, like appraiser companies. They're now under a certain standard in order to protect everybody. And so we're operating as usual, but using the new guidelines. We're also making sure that, of course, all of our staff members can work remotely, especially if they feel sick and they quarantine themselves. So again, part of our goal here is to make sure that we're being cautious and using wisdom, but we're not allowing, and this is something I want to reiterate, we are not allowing a pandemic to create emotions that make us make mistakes. And that is the biggest difference. If anything, as a real estate investor, as an old quote comes from Warren Buffett, when there's blood on the streets, you buy real estate. And I want to be very specific. I'll talk more about our strategy and what we would recommend a little bit later on. But it is imperative that we understand that when we allow fear to take over our lives, we allow fear to dictate and we make bad decisions based on emotions. So I would highly recommend that you use this information to dispel all of your fear and your misconceptions and position yourself as a real investor to really capitalize in this particular, what I'm going to call opportunity.
Awesome. All right, so we've got about 75 people in the room, Rick, so the floor is yours.
Yes, sir. So first and foremost, just kind of walk you through a little bit. You know, we know, and I think almost every single person has actually been stuck to the news, watching what's going on, and, you know, watching all the memes and jokes that everybody's also putting online, which I guess is natural. But what we decided to do is, instead of actually looking at the media per se, yes, there's regulatory bodies that are making some really professional recommendations. But what we started saying is, hey, we've been students of the market for years now. We've learned a lot from looking at our past. I wonder if there's some additional data that we can pull up in our research to help us to identify how we should be treating the market. So I think in the first few slides, what we're going to dive into right now is to show you that even though this is a very unique situation, the reality is there's nothing new under the sun. And so what I would like to do first right now is transition to this upcoming slide here. So you guys tell me real quick, just so I can make sure it's already there. So what I'm showing you here is, as we started doing our due diligence and working with our team, and in a minute here, I'm going to go ahead and actually show you a bigger screen, but just want to give you a little perspective. So during our due diligence, we started going back to all the different corrections to see if there was any correlation at all tied to actual circumstances like the ones we're facing today. And so I'm going to show you a couple of things so that we look at it. We're going to summarize it, and then we're going to dive in. So hopefully this will give you a bigger visual. So we're starting with one of the first corrections, which was 1797. It was actually land speculation bubble. That burst, and that caused an economic correction in that marketplace. Now, it's interesting to note that there was a cause and effect. So it was a bubble based on speculation on land acquisitions. The next piece that we look at is in 1857. We had a failure of Ohio Life Insurance Company that literally threw the market into another correction. That again had a cause and effect. I'm going to go ahead and fast forward to 1873. Large bank fails. There's a lot of different railroad financing that took place. People that were getting greedy. They were getting too strategic, and obviously there was a major correction there. Then we have the insurance or the situation with 1907, which was New York's trust also made some errors, and they were very, very well vested, and it impacted the economy as a whole. Now we get to our very first correction that is tied with some of this stuff. And this is actually in 1918 was the first official epidemic that took place that impacted the United States. But it is important to note that in this particular correction, it actually started because we had just finished the World War I, and we were struggling financially. We were bringing soldiers back. There was a lot of people that were injured. There was a lot of crisis. And then to add insult to injury, all of a sudden we get this pandemic very similar to what we're dealing with. So in a minute, I'll show you exactly what the stats show us about that history, and I'll kind of walk you through that. But what is important to note is that during this particular correction that was taking place in the market, this pandemic was horrifying. I believe over 500 million people across the globe were impacted by this and were made ill. And of that, close to 50+ million people worldwide died from this particular pandemic. So I just want to give you perspective. This is not the first time, and it will definitely not be the last time that we deal with a pestilence like this. If you want to have peace later, you can read the scriptures. I'll tell you more about that. It already talks about this, but I want to make a point. That's why I left it in red, that this was one particular correction that did have a pandemic take place. Now we fast forward to 1945. There is yet another situation because of World War II. Fast forward, 1949. That was yet another particular correction. I'm going to fast forward now to 1953. Do you guys see a cycle here? We keep having all these crises. Most of it has to do with debts and people that are speculating. But now we fast forward to 1957. And then 1960, there was a manufacturing shift in America, which actually caused some foreclosures and some additional financial distress within the country. Next, we transition into the 1970s, which is inflation. We go right into, again, the wage prices that we had an issue with gold standard being abandoned on 1973. Now we fast forward, 1980, we did have the Fed inflation, which actually was another correction in our market, which created a bump. And now we transition into, again, 1990. You guys see there's a trend. There's always different cyclical pieces, but now I want to point something really important here. You have 2001. In 2001, there was a tech bubble that was followed by the 9/11 horrifying experience that we had. And before you know it, as we begin to transition to add insult to injury, guess what happens? We also have another pandemic, which was called SARS. That was in 2003. So that was impacted. The market did correct. And of course, everybody knows the housing crisis of 2008 that we've all pretty much lived through. And last but not least, now we're dealing with the coronavirus. So I want to give you a visual of timeline, but I want to highlight those 2 points in time where there was a pandemic tied to this. And I want to show you some things real quick, if that's okay. How are we doing so far, Greg? Does that so far give us a nice little highlight? We're good on that?
So far, so good.
Okay, perfect. So this is the big question. Based on all of these markets that I have highlighted for you and surveyed, if you take a look at the stats, what do these recessions up until now have in common? And even though we have 2 time periods that did have a pandemic of some sort, the reality is only one thing, and that is that they were not consciously chosen, meaning there were already other causes and effects that were causing this market correction. Okay, so there was a cause and effect based on market trends, based on inflation, based on a variety of different factors. If, for whatever reason, I'm going to say if, because I don't really believe that this is actually a market correction right now. I'm going to be completely honest with you right now. As of right now, and I'll show you why, we're not dealing with all of a sudden a horrible collapse in our market, okay? So if a 2020 coronavirus occurs and it becomes a new correction in the marketplace, it would be the first time in our history that we know of that the recession was done by choice due to fear. What do I mean by that? That means that the reason why markets are freezing, the reason why people are acting right now has nothing to do with the market indicators of any other cause and effect other than the fact that we're basically saying, I want to be careful, what do? I don't want to get sick, I want to be responsible, and the government is doing the same thing. So in essence, it is a choice that we're making to pause doing business in order to figure out what's going to happen next. And so that is the reason why we're seeing a market slow down, and it's imperative that we understand that. Now, I'm going to transition to the next slide here, and then maybe from here, Greg, if you have any questions, I'll be happy to answer that, and then we'll transition to the other part. But this is why this is so important. Now, most of us don't remember, but when SARS actually, the epidemic started breaking out, it had a massive impact, and people were very scared. In fact, look at that Newsweek picture. Hey, can this be stopped? It was a very similar emotional freak out of, if you know, of human nature, where we're scared, we don't know what to do. And to give you perspective, here's the impact. During that year and a half from 2003 to about 2004 and a half-ish, we had a 1.75% loss in annualized GDP, or what we would consider a 5.1% monthly loss at peak, okay? Now, with that said, a quick recovery to the actual trend after the end of the panic took place. And literally, a 1.3 increase in unemployment happened almost like this. Unemployment recovered within 3 quarters after this entire mess. And what's interesting to look at when we started looking at the real estate market, because in that particular scenario, we have a lot more data, what we saw is that statistically, it was an insignificant 1.9% fall in houses and their pricing. Why do I say that? Because again, we had another pandemic. It was spreading. It obviously impacted our GDP. It had a ripple effect in our market for sure. But within 3 quarters, there was a full recovery of the market. We were back in swing of things, and the real estate market was only impacted by roughly 1.9% drop. That's important for us to know that. Now, as far as count of transactions that were down by an average of 33% for the duration of the pandemic, obviously that's normal. Why? Because people didn't want people in their homes. So what that did is anybody who was trying to sell a house says, let me get this off the listing. I don't want anybody coming to my house with the cooties, and I'm scared. I don't know what to do. And so obviously for that reason, that created that scare that paused the industry. But it's important for us to note that, again, we really didn't have a major drop in our house prices in that market. So before I continue and I talk more about the impact and I show you about housing numbers and I show you about the S&P, Greg, I want to pause real quick and find out from your perspective so far. Do you have anything you want me to clarify so far? Is everybody following along?
Yeah, I've been doing obviously a lot of research on this as well myself, and you nailed it in my opinion. Like, this is not created by something that was fundamentally wrong with our system, if you will. This is done by fear. We do have obviously an issue from where this started with in China, obviously where this started was a lot of manufacturing. So because of the fear of getting sick and the draconian ways of China, it slowed a lot of the supply of all of the goods and plastics and oil and not oil, plastics and electronics and stuff like that. So, you know, it's because of the fear. It's not because like we didn't do something right in our economy. So
absolutely,
yeah, when we had our team meeting on Monday, we had a lot of our agents on our team basically said that they're having sellers getting cold feet because they know that they don't want people in their house. They also think that they're probably going to take a bath if they were to try and list it now because people are going to be looking for the discount.
Right. Yeah, so it's, and we'll talk more about some of those strategies towards the end, but absolutely I agree with you. And it's important for us not to freak out, guys. I mean, let's be honest. This is going to be a season. This is actually one of the fastest time in history that I've heard. Within 65 days, they're already doing human trials. That's freaking mind-blowing to think about that. So obviously they're putting a lot of resources. We can definitely trust that our government is being very proactive. I don't care what anybody says politically, forget the politics. Let's look at the fact that we're really being proactive. And I really can't stress enough that if we want to shorten this, we need to listen to what they have to say. And we need to separate ourselves for now so that we kill that window of spread, which is really what caused that major, obviously the impact in other countries. Now I'm going to transition more. I'm going to give you about 2 or 3 more specific visual slides of how these previous pandemics, specifically SARS, because we have a lot of data on that, how it impacted the S&P, housing starts, and so forth. And then what I'm going to start doing is everybody usually starts asking me, Rick, what should we be looking at right now? Like, what are the indicators we should be looking at? How do we know that we're going on a tailspin or if everything's stable? So I'm going to share those with you in just a second, okay? So let's begin with the S&P. I want you to visualize this because you almost, even if I told you statistics, you wouldn't even get it. You'd be like, it doesn't make sense. So now let's take a look specifically on the actual SARS epidemic. Let me show you what happened with the S&P 500. So now what I want you to see, and it's kind of difficult because there was an H1N1 also pandemic that took place in 2009, but I think we were just so overwhelmed with the economy as a whole. That was a bigger pandemic in most people's eyes. So I'm just going to disregard that data. And what I want you to look at is look at 2003. Look at that blip right there in time. From a moment that we had just had the 9/11 took place, we already had the actual meltdown of the bubble that took place with the technology and all these dot-coms. And then we get SARS. And yet, if you look at that timeline, that circle that I have here, was it a major recession? Did the S&P drop for a long period of time? The reality is no. Within that blip, after everything started getting stable, look at the growth that took place. And so it's important for us to realize this too has already happened in the past. Now, to give you another piece of perspective, let's take a look at the actual housing starts, construction of properties. Going back again to 2003, look at that blip. There was a fall, but it didn't even last more than a year. So as soon as people saw that things were getting under control, guess what happened? All the developers, investors go right back to normal business and redeveloping. So was there an impact? Yes. Was there a long-term effect? No. And that's a real critical piece that I want you to visualize. Now, again, if you look at the bottom part here, obviously that was the 2008 crisis, right? That, in my opinion, that's more of a pandemic than what we're dealing with, but you can see statistically speaking just how quickly this impact took place and where we are as the chain continues to grow. So again, look at this blip. I want to give you perspective so you don't freak out. Stop looking at our market in days. Look at the market within a time span of 12 months, 24 months, because if you don't do that, you're going to drive yourself crazy for absolutely no freaking reason. Let's be honest, okay? Now, let me give you another perspective. Now, let's talk about house pricing. So, okay, construction went down, S&P went down. Let's take a look at pricing in the marketplace during an actual epidemic, which was caused by SARS. Do you see the blip? Is it that significant? No. But I can assure you that during 2003, people were freaking out. Oh my God, this is going to be the end of the world. Can we possibly stop SARS? And the reality is, instead of seeing prices drop in real estate, even though we saw the volatility of the stock market as it did drop, the reality is the activity stopped, but the prices were barely impacted. And that's the point that I want to make. So if we see a slowdown, the reality is most likely, most of that slowdown, it's only going to be impacting the activity, not necessarily the pricing. So hopefully you guys understand that. And again, later I'll talk a little bit more. So now let's transition. Some of you guys may be saying, okay, this is great, Rick. Thanks for sharing this picture for me. But what should I be looking at when I'm looking online and I'm doing research? So these are some of the key indicators, and I'm going to walk you through some of the years that we need to be looking at. And this is what our economist constantly is keeping an eye on and letting us know, hey, this is how we know that we're entering into a major recession. So let's begin with the first one. What you need to be watching right now is watch the initial claims for unemployment. Okay, and if you start looking at this data, I want you to gain a little perspective. So again, if you look at the screen, this is in the 70s. And what you'll notice is these little gray pockets you see, these little graphs that show gray actually represent market correction. So these are very well tied to different times where we had what the actual economy considered an economic correction of some sort, okay? What you're gonna notice is look at the peaks, and then you see those valleys, peaks, and each time it was based on a recession. Do you guys see that? Now take a look at where we are right now. So the reality is, can we expect there to be some growth in claims for employment? Common sense would say, because of what we're dealing with right now, even though the government is being very proactive and trying to find out incentives to keep business going, there are some industries, especially in Orlando, next to Mickey Mouse, where some people are being hurt, right? So I do expect that to grow. But the magic number is if we're below 200,000, the moment we start seeing the claims jump up to the 300,000 range, that is a danger zone. That's where we can literally say, this indicator is telling me that we're no longer just in fear, we're now in a position of economic weakness that could go into a correction. Does that make sense? So keep an eye on these, on the unemployment. Again, we have plenty of room here, in my opinion. And also to give you perspective, even though a lot of companies are shutting down or not being able to pay people, you have other companies that are benefiting from this. Amazon is announcing almost 130,000 new jobs that they're doing. So there is going to be an offset. There's still going to be growth, and I'll talk a little bit more about that. All right, so let's take a look at the next thing you need to look at. So in addition to looking at the initial claims of unemployment, which you're looking at right now, the next thing we're looking at right now is the unemployment rate based on a 12-month average. I'll say that again. We're looking at the stats based on a 12-month average. Now, understand that with this data online, the government obviously publishes this information, but I want you to take a look specifically. In the 70s, where there was a correction, I want you to see a very clear distinction. The black line represents the actual average, which is what we're talking about. Currently, we're at 3.5% on a 12-month average, okay? The blue line represented the unemployment rate as it happened actually. Okay, so these were the actual impacts. So what you'll notice is that during the correction in the 70s, we saw the peak in the unemployment average going higher than the average. And you'll see it again in 1980s. You'll see it again in the 90s. You'll see it again in 2003. Obviously, there's a massive drop here with the correction we're aware of. And then you see the spike here, see where this was actually having an impact of unemployment. Now look at the drop. So what I want to say to us, and this is what I was discussing with the economists, when you're looking at the average, meaning the 12-month average of the unemployment rate that is being published, we're at 3.5%. When you start seeing that that blue line jumping up into the 4%, there's a massive indicator there that there's an impact for us. So keep an eye on that. Now, if it's at 3.6, 3.7, it's not going to be a major piece, so don't freak out. But my point is, if we're seeing unemployment as a whole crossing a barrier, and now we're seeing this particular rate going beyond the black line, which would be an average of 3.5 right now for the 12-month period, then we need to keep an eye. We need to be more prudent about the way that we manage our money and our investments. Okay, so that's a key indicator to look at. Next, I want us to really focus on it. This is something the economists really hit. This is a very important piece. Watch the month-over-month employment. Notice how everything has to do with what? Income. Because if you don't have money, you can't spend money. And if you don't spend money, somebody's not making money. So that becomes the impact. That's why these are such key indicators that we have to be aware of. So now if you go back from 2017, which is what we're looking at in this particular report, what we're calling the equilibrium here is 200,000 jobs on average, okay? Now, understand that we kind of have some skewed data right now because technically, because of this impact, that may shift a little bit, but the next report that the government's gonna publish is due April 3rd, which is basically, they do a report the first Friday of every single month. So you can pull this up on public records. The next one's April 3rd. So you can keep an eye on this one very specifically. What we're guessing is that as long as our bottom line equilibrium number is 200K, and we're above that, which currently we are, which is the job growth market, more jobs coming in. So even if we're losing jobs, but we have monster players creating new jobs, and we're hearing about all these other companies that are actually creating more jobs, then like grocery stores and all these other groups that are benefiting from this, then those jobs will balance out the jobs we're losing. So we want to keep an eye April 3rd to make sure that we don't drop below 200,000. If we do, that is yet another indicator of something that will be called a recession for us, and we have to treat this completely different, okay? So that's another thing to keep an eye out. I'm going to keep going here, right? If you guys are okay with that. With regards to the 30-year mortgage rate, this is the reason why I thought it was just a weird moment, okay? In history, look at them from the 90s to date. What you're looking at here is the actual 30-year fixed mortgage rate, and you will notice that it's almost historic records. Now, my economist was talking directly to a couple of other experts too about this, and he said that most experts would actually concur that they can't see a long-term recession within our market that would take place with these kind of rates being so low because of the affordability. In fact, even now, I've talked to several retail lenders that I know that we sometimes send business to because, you know, obviously we only lend on business purpose loans. So they're telling us that they're even right now still getting hammered with people trying to refinance to cash out some money and be at the low rates. So the fact that we're getting still that activity is because the rates are so low and it's very beneficial. So we believe that this is something that's going to really help overall the real estate market. So again, just keep an eye on that. I don't suspect that it's going to get any higher. And go ahead, Greg.
Lenders are saying us the exact same thing. All of our private mortgage lenders are telling us that they are just inundated with new loans, even after this has started to get, you know, out of hand with the media and everything. So like, yeah, absolutely. I don't see how, if we do go into a recession and our rates are this low, we're in trouble. I don't know. I don't see that happening yet. So we'll see.
I agree. Yeah. I agree 100%. So again, as we kind of go through the rest of this, let me just go back here. I just want to make sure that we covered some of these key things. Hold on one second. All right, so we're here it is. So now this is what I call, and again, it doesn't mean it's the most important, but I want you to take a look at, because we just talked about the 30-year mortgage, but there's also an impact related to the banks, how they get their money, their cost of money versus what they're trading at. So what you're looking at here, and I'm not going to go in too much detail because I just want to make it simple for us to get a visual. You literally have the 10-year yields less the 2-year. So this is basically a short-term yield spread and cost and what they charge versus what they're getting. And then you have the long-term, which is the 10-year, right? Which this includes the Federal Reserve funds. So the reality is the current yield curve does not signal a major recession at all at hand, which just further confirms. So when do we see a potential correction? If you saw the key indicators that I talked about earlier, that we talked about, keep an eye on unemployment, job growth, and those numbers, and then you start seeing that the actual institutions are going into a negative. If they're going into a negative, that's a problem. Because remember, if they're going into a full negative on the short-term yield spread rate that we're talking about here, if they go below a 0 long-term, in addition to these other indicators, what that means is that our country cannot continue to absorb more and more loss before it ultimately has an economic, what we call a deleveraging. So that's the reason why we're taking a look at that. As of right now, on the short term, it looks like it's healthy at a 0. If anything, it might spike up a little bit later on as the confidence of people come back up. But as of right now, again, we're looking at that. If you start seeing it in the negative half and then going to 1, that is a pretty clear telltale sign. Somebody's got to pay that bill. That means that the government is borrowing more and they're losing money on lending the money. Just think about that for a minute. That's crazy. So again, that's something we're looking at. All right. Now, the last piece here, and then I'll talk about some of our key components for the strategy, is China. Everybody's saying, oh my gosh, what about China? Is that going to impact us? So I want to make a really interesting point here, okay? Understand that even though our country is in a lot of debt, okay, and in my opinion, we're weaker than we've ever been. There's many reasons for that. But the reality is, for the most part, we're still considered world power. And so the U.S. can literally withstand most external pressure from other countries struggling. If anything, when America gets hurt, all the other countries get impacted. That's where we're at right now with that. So, but what I want to make is a point that the reality is, because China has gotten so big and we depend on them so much, and there's so many components that we're intertwined with, the reality is if China continues to go any lower, it may have an indirect impact on the US. I'll give you just one company, for example. Right now we have Apple. Everybody and their mom has an Apple phone, an Apple computer, and everything else. They do a lot of business in China. If that recession impacts that industry, then we will have an indirect impact in US dollars, whether our cost goes up on those phones or whether they start producing less profits, which makes them less, basically valuable, and they'll be more stringent. So again, there will be indirect consequences. But when I talk to the economists about what are your thoughts, looking at these particular charts, they feel like it's going to level out because of the percentage of recoveries that are already taking place, and because most everybody around the world is trying to be proactive right now, taking this serious. So that's a really good sign. But again, what they're showing us here is that, we're looking at, for example, the retail sales. Obviously, that dropped year over year. We're looking at the industrial production that dropped by 14%. Look at the housing starts, dropped by 44%. So obviously, there's been a huge pause, but most economists at this point are saying that they feel like they're hitting bottom and it won't make a massive impact on our country. But again, I would say if you're a prudent investor, keep an eye on China. Let's make sure that you take a look, because there will be some form of an indirect impact with what's going on in our market and in our economy. Now, I'm going to talk a little bit now about the cycle and where we are in the real estate piece. And what I'd like to say is we don't have a lot of time today for me to really go in a lot of detail. But what I really want to encourage you guys to do is reach out to Greg, reach out to us, and we'll be happy to send you the forecast that we prepared. And one of my partners, Luis, worked with Sam and our economist to put together a really robust report, which was an outlook for 2020. This actually was taking place prior to the coronavirus making a massive impact. And the reason why I want to show that to you and give you those details in a report, so if you request it, we'll email it to you, absolutely free. We just want you to have it. Go through those notes and go through those charts and read the summary at the end. Because what you'll see is that the real estate market didn't really have any key indicators showing that the market was going to be correcting. So again, this truly is a cautionary market pause where people are pausing because they're afraid and they don't know what to do. But if you want to get more data, more statistics on what are we looking at in the real estate market, instead of spending all this time right now to share those details with you, just request a report. We'll send it to you, and you can go through all of those details with us and really make sure you get your head around what we're doing. So what I would like to end this as we start going into the Q&A, and this is a critical piece that I want to really make sure that you guys understand. I have literally had, at this point, close to 50 phone calls within the last week and a half with investors from all over the world, even from Brazil, our passive clients, investors from Ireland, people here in the US. Greg, even you were calling me to, hey, how can we discuss this? So we've had a lot of people that are saying, what the heck is going on with the market? What's going to happen? So I want to point to a perspective for you guys, okay? We were currently, or still are in essence, in a growth stage in our market. But we know that there's 4 stages. Growth stage, we have the absorption stage, which is around here. We have obviously the declining stage, and then we have the saturation stage, right? And this is the bottom of the market going back to the growth cycle. What I want to share with you is this. Based on the data that we are looking at right now, and we may publish additional updates in the future, the truth is, at the worst case right now, we may literally be at a neutral market, meaning that we don't have a lot of sellers willing to sell, and we have buyers that are pausing or maybe not as aggressive, and most investors are the ones trying to buy. So the point I'm trying to make is we're not expecting for this to happen right now and there to be a decline in prices. However, let's pretend worst case scenario happens and all of a sudden we're all out partying, we're all getting sick, and people start dying, and the percentage goes from like a 1% or whatever the ratio is of fatality rates to a 15%. And now we're talking about hundreds of millions of people dying worldwide. Everybody freaks out. The market goes to hell in a handbasket. So even looking at that picture, and let's say the market drops, that would only mean that we're going to bottom out, which becomes what? A buyer's market. So if you're an investor, at the worst case scenario, if you're positioning yourself correctly, you're just putting yourself in a spot to buy the deals at a fraction of the cost. So what I would encourage investors to do right now is literally think about it from this perspective. Number one, if you can control it, focus on affordable housing. Why? Because that is the biggest segment in our economy of people that are needing homes that are affordable. So I would avoid at this moment extremely high-end projects. In fact, our company is taking a measure. Any deal that is over $600,000, we're literally going to fully analyze it, and most likely we're going to turn it down for right now, just because we know that that market by default has longer days on the market, and it may impact somebody if they have debt. They won't be able to pay us if they prolong this for another 12 months. So if you're an investor, I would be looking specifically for affordable housing. The next thing to say is this: it doesn't mean you can't flip. I can tell you that during this stage of the cycle, our company was still buying homes and flipping homes. The difference is in the way that we approached our flips, which I'm going to talk about in just a minute. Number one, we anticipated higher and longer days on the market. So if you're going to flip a home right now, understand buying is a good thing. But when you go to sell, understand that the days on the market may be longer because of this circumstance. I still don't expect it to be crazy, but again, if you're buying affordable, you should still sell it, but anticipate longer days on the market. So if the market says that on average this place is 60 days on the market, give it 4 months in your analysis. Give it 5 months and make sure, do your financial models on that deal still make sense if you're doing that deal within that timeline? The next thing I would look at is, are you at the very top of the retail market like most investors try to do, where they're pushing the envelope, almost trying to sell a house for even more than it's worth? So if that's the case, yeah, you're going to be there on the market longer. So be a little bit more conservative, right? Be a little bit more conservative, and maybe make sure that you put in there maybe a 5% fudge factor for being able to give incentives or dropping your price just below retail so that your property is going to get the most visibility. Now, I'm not going to discourage not listing homes, because remember, just because people who live in homes aren't willing to list their homes doesn't mean that if you have an empty house that's beautiful and staged, you can't put it on the market and other people will look at it and want to make an offer to buy the property from you. So again, most of the properties, if you look at realtors, and we've been reaching out to realtors. In fact, tomorrow I have a webinar at 2:30 with, him, Chris McLaughlin, who's got over 800 agents. They want to do a debrief with their agents. And most of the data that I'm getting from big agencies that are doing the real estate side is what they're telling me is that most of the people who are pausing or hitting the brakes are the consumers who don't want people coming to their home. So this further confirms that if you have an empty home, why not list it? Just give yourself enough time for this thing to shake out.
We listed one today. We had several showing requests already.
Oh, are you? Yeah, I agree.
In the affordable housing, we're listed for 170. I could look it up, but we had, within the first couple hours, we had several showing requests. So, because it's vacant, no one's living there. So, yeah, it's not a big deal for us.
Exactly.
It's not quite business as usual, but it kind of is.
Exactly. So again, it's critical. Make sure that you already anticipate for longer days on the market. Price it right. I mean, let's be honest. You don't have to hit home run for every deal. Price it right so that you can move quicker, right? The other thing that I would encourage, and this may not be, if you already have a pipeline of deals, this may not be as feasible, but what I'm telling people, even the deals we're looking at potentially buying, is, do I have a plan B? So what does that mean? In the event that we buy up 3 or 4 properties, and for whatever reason, the market's not moving right now, things are still a little shaky, can I rent that property? Because still people need to live somewhere. So can I rent that property for even 6 months and then allow the cash flow to maintain it till I go back and do the full renovation and then sell the property for retail? So if you're in a higher end home, that gets a lot harder to do, right? Because now you're dealing with a property that the debt service is going to far exceed the cash flow that you can generate. So again, if you stick to affordable housing, even if you broke even at the worst case scenario, having a plan B is a good thing for you. And the other piece, which I'm going to really hit really hard, don't panic. We are our worst enemies. If you're sitting there and you're literally having anxiety attacks because of this, you're listening to the wrong stuff. You need to give it a break. Consider the fact that this too has happened. Look at the history that we just talked about and understand that this too shall pass. And I'll even challenge you. Are you making this coronavirus your God, or do you have a God that you could trust that has your back regardless? And so I want you to think about it from a bigger perspective. Don't panic, because when people panic, they do stupid things. Just start thinking a little bit longer term, and you'll see that over time, this too will pass, and you'll see the market recorrect and grow back, just like the last 2 recent pandemics that took place also came back fairly quickly. So that's a real key here. So for those who have any questions, if you want to have more data regarding, like we just talked about, as far as to the forecast, you have any additional deals that you want us to help you analyze, whatever it is, we have our information there. You can email opportunity@hiscapital group. You can call us. You've already got, of course, Greg Simpson's information, so you can feel free to go ahead and reach out through him. We'll make sure you get the forecast. But for now, I feel like we've covered quite a bit. Let's go ahead and do a Q&A if you want, and we can start discussing a little bit more about this.
Yeah, so I got a couple questions that people have put in the chat so far. Let's see, first one. How close can we be before negative interest rates happen and it costs us to put money in the bank as other countries have?
Yeah, so again, looking at that right now, based on where we are, we're at 0. I don't suspect, even if we did go negative, it would probably be within a quarter or 2 quarters at the max. I don't suspect that that's going to impact us substantially. The only time that I could see this happening is if right now we went into a full-blown recession and the market collapsed, we could be in the negative, and then that could be where we start seeing an impact on that. But as of right now, short-sighted, looking at it from this perspective, I don't foresee that happening anytime in the near future, if I could be honest with you.
I don't either. I think that we've already kind of leveled out with that because it didn't work to fix the stock market tumble. So that was actually another follow-up question. Did the Fed jump the gun on cutting the interest rates?
I think they're trying to be as proactive as possible. This is what sucks about being in that position, right? Let's be honest, right? If they didn't cut it now and something goes wrong, they're the devil.
Damned if you do, damned if you don't.
Exactly. If it goes the other way, why didn't you do it soon enough? Or why did you take so long? So the reality is, I almost feel like our mortgage, before this thing really started blowing up, the government was already pushing this. They were already trying to come up with an incentive way to make mortgages more affordable so people can transact them. So what I would be looking at more right now, if you're looking at it from that perspective, is look at the fact that the government is also buying the actual bonds. They're actually buying the mortgages back from institutions in the short term that weren't able to sell it because of the pause. So they're even investing into yields that are paying them. So, and at some point they'll be able to flip that paper to other, like they typically do. So from that perspective, I feel that could they have been too early? Maybe. In the long-term picture, doesn't matter, not as much. I think, what's even more important for us to look at is if we don't listen to our government and we're going out there every single day and we're exposing ourselves on a regular basis, I think that is more dangerous and more detrimental to our market than whether we lower the rate to 0 right now, if I can be honest, because we literally have the power as a nation and as the world gets together now that we're basically virtual and online. If we decide that we're going to take that precaution and we stop the spread, we stop this pandemic. We slow it down to the point that we can basically coexist. And I really think that's more of an impact in our market than even being at 0% right now.
Yeah. Another good question. If you were to guess, when do you foresee markets going back to pre-coronavirus levels?
I think a lot of it, at this point has to do with the different incentives that the actual government is putting in place to help to stimulate our economy or to help the people that are struggling financially. And I think we just have to look in the media and really identify when they literally start doing the clinical trials and things really start shaping up. I think we'll start getting confidence in the market again. I hear the president and some of their advisors are saying that if we cooperate as a nation, that we might be able to see this thing flush out by, as early as July. And that's a possibility. I can see that as a feasible option. But again, that all depends on whether we want to cooperate or not. If we're getting sick, and let me tell you, they've said it and I agree, the baby boomer, which used to be the biggest category group, let's face it, there's a big percentage that's dying. So what is outpacing as far as growth and the people that are not being impacted as much are who? Millennials. Mm-hmm. And so really the reality is millennials need to partner up with all of us, and we need to make sure that we're being cautious. Hey, even though you may not get the same symptoms and you may be at a 0.002% chance of dying if you do get sick, the reality is you can still pass the virus. Right. And we should be respecting our elders and our children enough to also be responsible. So I would really caution everybody and ask everybody to participate, because the faster that we cooperate and the faster that technology takes place, let's stop blaming pharma. Let's stop blaming pharma. You know what? It is good that there's competition. Let them fight it out and find out who finds this freaking cure as quickly as possible, because that too will be an impact. So let them go to the races to see who's the big boy who gets the actual solution done. For now, let's just us do our part. Let's be responsible. Let's start really listening to what the government's saying to us so that we can truly implement the right strategies and see this thing turn around.
I agree 100%. Like the longer we as a society believe that this isn't a problem, and I don't know if you saw that it was going around today. It was a picture of people on the beach. I believe it was here locally, and it was like the beach was packed in one area. I don't remember what beach it was, but like, are you freaking kidding me? So the longer we don't heed the advice of not just our government, governments around the world who have seen slowdowns in the spread of this because they've quarantined or self-quarantined, you know, this could go on for a long time. But if we actually do what we're supposed to do, and we could actually get this done, like you said, I think the summer will hopefully be the time that this kind of like corrects itself.
Yeah. And I hope sooner. I mean, I really hope sooner. The fact that they're already doing stuff right now, as far as doing human trials, that's huge. Honestly, that's a massive, and I've heard that in other countries, they've tried other medicines that were there and they're starting to get some positive improvement. That's very good. So let's just do our part. Let's try not to get sick, and let's not try to pass it on. And I think, you know, we'll be contributing by doing that.
Yeah.
Was there another question?
So we got a couple more questions here.
Sure.
Do you think that the major lockdowns in many states that will inevitably increase unemployment rates within a couple of weeks will be short-lived and unemployment levels back to low within a few months?
Yeah. So again, we're going to see that happen. And I think in some places where we're getting, you know, like where you look at Seattle, for example, that's going to have an impact. I mean, year over year, the listings dropped by 50%. They're putting tighter and tighter restrictions in some of those markets where they're seeing it spread the most. So obviously, by default, some of these small businesses cannot afford to continue to pay their employees while their shop is closed. So it'll be interesting. I would say that while there's other industries that are thriving and hiring new people, so there might be a shift where people go from this industry, bartending, they might switch now to go work with Amazon. I don't know. But in the interim, I believe that the government is trying to be very, very aggressive about putting programs in place to help those industries that are being hit the hardest. And so that, I think, is going to help counter that. I don't suspect our unemployment rate to just, you know, explode exponentially overnight. But I do expect that obviously there is going to be an increase in this issue. But long term, I don't see it being a massive issue, especially when you look at back in 2003 and even in the 1918s, it wasn't that substantial. It wasn't like it halted the entire, you know, economy, even when they had other indicators that were causing some of that correction.
Yeah, so a good question that was asked was, let me find it again, sorry. Do you think that lenders will be forgiving when maturity comes during this event, such as yourself?
Of course not. I want your house. No, I'm just kidding. I'm sure there's going to be some type of program in place. There will be grace. You know, I know we're putting a plan in place for that, to work with investors to make sure that we come up with ideas. The reality is, and I'll be honest with you, do not, if you have a lender on a deal, I don't care if it's hard money or you're with a bank, do not stop communicating with them based on your circumstances. Literally, when a maturity is coming due in my office, we typically look at it, and we usually follow up about 4 months before maturity. And then 3 months, we get a little bit more aggressive. Hey, what's going on? Let's talk about your plan. So when we reach out to you, if you're borrowing from us, communicate and let us know ahead of time so that we can start working on whether we need to do an extension or whether there's a possibility to refinance and convert that deal into a 30-year mortgage for a rental property. So you'll have options if you communicate proactively. But if you don't communicate and then they finally reach you at the end and you're like, hey, I'm sorry, man, things aren't going so well. Well, you're not going to have as much grace because people have been reaching out to you to find out what's going on. So I would say if you're struggling or you need some help long-term, communication is going to be the key with your lender. And that's what we're trying to do. We're putting processes in place as we speak to start chiming in with our borrowers, generally within 4 months prior to maturity, to figure out what we can do to come up with a better idea or solution to help them.
Okay. If you guys have more questions, make sure you ask them. If not, we're going to wrap this up. We can do a quick recap because we're only planning on doing this till 8 o'clock because we all have families to get back to.
Greg, 2 quick things if I can. I think my partner Luis might be on the call. Luis,
he's been commenting a lot, actually. Yep.
What was that?
He's been commenting a lot on the thread and answering a lot of questions.
Beautiful. Luis, I don't know if he's able to mute himself or not. I know he worked with us. Hey, Luis. So I know Luis worked very diligently with our economist and Sam as we were putting together the forecast. Is there, and I didn't have time to really go into the real estate indicators. I want you guys to read the report because I think it was very well put together and it's got all the details on it. But as a quick summarized version, Luis, can you kind of share what your summary was so that people gain perspective from what we were just talking about?
Yes, thank you. And definitely, we just want to make sure everyone understands the difference between an economic recession and a housing crisis. Those are completely different topics, right? But they kind of do affect one another. So we do have probably upon us, based on what the news say, the possibility of having 2 consecutive quarters with negative growth or a significant decline in growth. And that would create a recession. Now, since the 1960s, we could confidently say that recessions have actually caused inflation. So inflation is actually good for real estate. It increases the values of real estate. Now, if we really look at the fundamentals of real estate and lending and where we are today versus where we were before 2008 and the crisis, before the 2008 crisis, we had the subprime markets where lending was super aggressive, generating speculators to drive demand extremely high, and it pushed the prices to the roof. And these subprime loans that had high debt to income ratios, low documentation, bad credit, high loan to values, all of those loans, remember the ninja loans, remember those?
Yeah.
Where people, no job, no income, no assets, none of that. All of those are gone. Since 2014, we have the Consumer Financial Protection Bureau, and now we have qualified mortgages. And the defaults on qualified mortgages now versus the subprime loans before the 2008 crisis are like at like a 1% of defaults versus 2008 peaks. So our housing fundamentals are there, our lending fundamentals are there. There is limited inventory, and we see that. We need more supply in the market to satisfy the demand that's out there. There's a shortage of housing as well. So we expect to see a growth in the housing market as well. So let's get those things straight and show that we're really here to stay as a lender. We're going to continue to lend. We're not going to change anything. We're not going to tighten our guidelines. We're not going to change anything. Basically, business as usual. Of course, we're paying a lot of attention to what's going out there, and hopefully we can get past this in a couple of months and move on just as we were.
100%. Thank you, Luis. That's so important. And the time on that is, again, that's the reason why we're building what we call the ARC with our third fund, which is part of making sure that if we work together, you usually generate more profits and you protect each other. And so that's what we're trying to do now, is be more proactive. We will continue to buy as usual. We will continue to lend as usual, but we're just looking at things from a different perspective just to be more cautious. So anyway, that's what we're seeing right now. I think, Greg, you're muted.
Thank you. I didn't want to give any feedback. So Michelle asked, I want to answer this one for, as a newbie, what should we be doing not to be doomed? Here's the thing, guys. The fundamentals of real estate don't change. You still buy it at a discount. You know your numbers. And like Rick said earlier on in the presentation, you might just need a little bit different of a fudge factor. You might need that 5% of a fudge factor on the fact that you may not sell it for what you think you're going to sell it for based on today's current data. So if you think the ARV of a property is $250 as of a week ago, because that's what that property sold for a few weeks ago before the hysteria started taking over, well, in 4 months from now, by the time you renovate that property, it may not be still at that 250. It may be a little lower than that. So just make sure you're doing your due diligence and not getting overly aggressive. And that's where I see from all of these wholesalers out there that are sending us deals have overinflated the ARV because they're using projected increases in the market, and that just doesn't work usually ever. And now it definitely isn't going to be working. So stick to the fundamentals of buying at a discount. You know, depending on what market you are in. I still don't buy over 75% of the ARV minus repairs minus a fudge factor. Unless it's in a hot area like where I live in Tampa and Seminole Heights, I'll go up to 78% because the house I just sold in Seminole Heights sold the first day of showings. So I can be a little bit more aggressive there, but I'm not changing my fundamentals when I'm looking at a property. So I hope that answers your question, Michelle. Just stick to the fundamentals and don't get too crazy.
Exactly. And if I can chime in on that,
Sure.
One of the things that I would just encourage you guys right now, in this frenzy, everybody and their mom is buying toilet paper. That's one of the biggest, jokes of all time at this point. I heard the joke, so it's funny, of what causes that. One guy sneezes, the other one needs toilet paper. But the reality and what I'm trying to say is, in the panic, don't go wasting money.
Yeah.
Don't blow your cash on stupid stuff. Just be responsible. Don't, get overwhelmed in debt, which obviously makes common sense. It's just common sense. And make sure that, again, you're just a little bit more frugal for the next few months, regardless if you're going to be responsible. It's not like you're going out to the movies every week. You're not going to go out to the club or whatever people do in the evenings, right? So just be more responsible, preserve what you do have. But if you have some money already ready to go, if there's an opportunity, just be a little bit extra cautious, pull the trigger. Because remember, at the end of the day, it is always, the market doesn't tell you when to buy, it shows you how to buy within each stage. So even right now, while all the wholesalers that are speculating are having heart attacks, they might have a couple deals that you can whack them over the head and drop that $30,000 wholesale fee they're trying to get anyway, and actually get a deal that makes sense.
Mm-hmm. Yep. I mean, I put one under contract, we'll be signing the contract tonight. We agreed to the terms already this week. I'm looking at one on Thursday that we've already basically agreed to the terms on that one.
Mm-hmm.
And we're just basically going to verify everything with my contractor on Thursday, make sure my numbers are correct. I'm going to obviously have my fudge factor built in. Like I said, it's business as usual, just being very cautious on what I touch and making sure I have hand sanitizer on me and not shaking hands and stuff like that if I'm going out there looking at properties. I don't want to say it's not rocket science and it should have common sense, but unfortunately there isn't common sense a lot of times these days.
Yeah, common sense is not very common.
Right. So again, stick to the fundamentals, guys. I think that's pretty much most of the questions that we already have answered most of them. So I think that unless anybody else has anything they want to chime in on, we're pretty much done here. So this is good stuff, man.
Absolutely, guys. We'll keep you guys posted. And again, I would encourage everybody as we continue here, just make sure if you want the full forecast to get all the indicators, details, we'll be happy to share that with you. Stay tuned. We're going to be, I'm sure, communicating more with Greg and sharing with the team as we see different indicators shift. If you guys even want, as Greg said, this is going to be, it's recorded. So there'll be an additional place where you can go watch it again. And if you guys even want, we'll even send you guys also the slide deck and PDF so you guys can have it as well if that's of value to you guys as well.
One last question for you, Rick. We got,
Sure.
Do you see this affecting smaller markets first? It's actually from Jason Lund, my old business partner in TB RIA.
Do I see it in smaller markets, so more rural markets?
Yeah, like affecting it first.
I mean, they obviously don't have as much resource, right? So even with government stimulus packages and things that like they're doing, let's just be honest, they're going to go to bigger cities. A lot of the money is going to the bigger pockets. So there might be a little bit more of an impact with rural markets. And if I could be honest with you, that's one of the reasons why we've really been very cautious on how we deal with rural markets and the real estate sector in general. So to give you a little backdrop on that, most of the hedge funds that are buying mortgages by the billions a year in private money and even in institutional traditional transactions, they have reported that close to a third of the properties that they foreclose on that they actually lose money or break even in are in rural markets. So there is going to be a trickle down effect because again, there's not a lot of resource. You don't have a lot of buying power in those markets. So if you're in a rural market, just be careful, be cautious about what those indicators are. Just look closer on your days on market, make sure you're really getting a good price and make sure that worst case scenario, that turns into a really nice cash flow property. Because again, it's kind of like Buffett said, if you're going to buy something, consider holding it for 10 years, right? If it works that way, then it's a home run either way. So just think about it from that perspective.
Rock and roll. Well, we got a whole bunch of people saying thank you very much, Rick. And I do appreciate your time with jumping on this. Again, because we had nothing to sell. We just want to make sure you guys are take this information and learn from it and apply it and still go out there and buy good deals, make money, save money, and continue on with your career. There's
one little thing I'll share as we close this for you guys real quick, just to say something that I know there's a lot of people that are afraid. They're dealing with fear. They've kind of lost their peace. If I could be honest with you, there's a scripture that I cling to. And that verse basically says, You keep him in perfect peace, whose mind is stayed on you. So when you find yourself in a position right now where you're constantly worried about my future, what's going to happen, are we going to get sick? Stop. Set your mind on God, the one who created you, the creator of the universe, who spoke life into existence, and know that he's got your back. Be responsible, but stop meditating on the stuff that gives you fear and allow God to give you the peace that surpasses all understanding. Everything is going to be all right.
Agreed. Rock and roll, Rick. Thank you again so much. We're going to end this
Thank
up.
you, guys.
I will get this out to you guys as soon as we can get this uploaded. So thanks again.
Thank you, guys.
For coming on too.
Mm-hmm.